Good morning, everyone, and welcome to the 2021 edition of our series Fintech Fridays, brought to you by BDO Australia. My name is Tim Ammon. I'm BDO's Global Fintech Leader, as well as the National Financial Services Lead. Today, we are changing things up a bit with a panel discussion about three great fintechs to hear about their journey and how they are disrupting their markets. Before we kick things off, I would just like to quickly draw your attention to the housekeeping slide that is currently showing on your screen. To start, you are all automatically muted, but we'll be accepting questions throughout the session, and you can submit these using the question tab. We have actually received a few questions already, and we've sort of woven that into today's presentation. We'll try to get to as many questions as possible. However, if we cannot respond to your question, we'll follow up with you after the webinar concludes. If you are experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, this session is being recorded, and all registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions, and the speaker contact details for all of us. The journey of a fintech is always unique, always challenging, and never linear. So what does it take to commercialize an idea into a successful business? Today, we'll be discussing the story of a fintech from the startup and scale-up process to exploring new markets and the need for constant innovation. With me today is Adrian Float, Managing Director at Spenda. Spenda delivers a fully integrated digital payment and business software solution that is designed to improve the way businesses trade and get paid. Spenda is the product of Seralto Limited and is listed on the ASX as CRO. I'm also joined by Mark Chia, Senior Marketing Director, Asia Pacific at Blackhawk Network. Listed on the NASDAQ, Blackhawk Network is a leading prepaid and payments global company, which supports the program management and distribution of gift cards, prepaid telecom products, and financial services products in retail, digital, and incentive channels. We also welcome Joel Thornton, Partnership Leads here in Australia at FundSquare. FundSquare is an international lender helping innovative companies large and small get funding and reach scale by investing capital in fintech startups in Australia, Canada, and the United Kingdom. Within Australia, there's a strong focus on the SME market. Good morning and welcome all three of you to the show.
Thanks, Tim.
Thanks. Let's start a little bit by talking about the growth stories into each of your organizations and what you've done so far. I might start with you, Adrian. Spenda is a product of Seralto Limited, an ASX-listed company that you co-founded, which licenses technology assets and services. However, even though you have a well-developed business, you are a self-professed entrepreneur at heart with a passion for solving business flaws and developing integrated payment solutions. How important as a founder is it to stay on top of that innovative spirit and continuous improvement?
Oh, look, I think as a founder, you're probably attracted to the risk and reward that goes with starting something. And I think when you lose the innovation edge, you're probably getting to a point where you're recognizing you need to bring in that traditional CEO that can sail the ship further and farther than your own skills are capable of delivering. So to me, innovation is everything. It's a big part of ensuring not just short-term success, but sustained success, because as the world changes and as markets change, you've got to have the capability to cope with that, adapt, and accept that business is a game of snakes and ladders.
Yeah, and I guess probably I know you're based out there in Perth, so enjoy the grand final tomorrow. I know it's a great opportunity for you. As an innovator, I guess what's it been watching the fintech ecosystem sort of transform here in Australia? Because you were involved quite early, and obviously the ecosystem has really expanded over the past few years.
Yeah, look, it's come a long way from our first payments product. We actually had a server with a connection to the ANZ, and it was like on a box in not even like a dodgy rack next to the toilet. So, you can't get away with that stuff anymore. Things have changed significantly, and I suppose in the last few years, what COVID's really done is turbocharged desire for digital. You almost look at people sideways if they want to pay you in cash. You wonder what kind of underhanded deceit is going on. So it's been it's been bloody pleasing. It's a shame I'm getting on the on the wrong side of 40 that it's taken this long, because we've been in and out of payments for such a long period of time. It's been a really slow early adopter. And I think now we're probably on the cusp of maturity.
I think maybe you can talk a little bit about your growth story in terms of the thought process around Spenda, and I guess what were some of those mission statements that you thought through when you developed that product and platform?
Well, really, it's been the school of hard knocks that's built the Spenda solution. I mean, from an Australian perspective, a lot of the times when you start something, you're really looking for like a foundational customer to inject capital, and you're building maybe not exactly what you want, but you're building something that gives you a proof point. And I suppose what we've seen over the journey is lots of different kinds of businesses. We've watched what works in one industry and looked at how we could tweak that and apply it to another. And it's taken, probably two key things for us that have been really special is we've been able to keep together a team of developers, sort of analysts, designers over a really long period of time. So there's a half a dozen of us that have worked together since like 1997. So we've had a collective journey, but each taking different perspective, which has made it, quite a balanced organization now. So whilst the Spenda product is, relatively new, it stood on the shoulders of lots of different products. Like our early settlement discount framework has been built off our return stack. And that's a really exciting thing for us to look at, well, what is a return all about? And why is it such a big problem now as we digitize? Because really it's a stock on hand vulnerability that's driving that. And, we've learned that all the way through. I learned that in 1997 working with Bunnings. So it's all been, incremental learnings all the way to here.
Okay, we'll come back and talk about Spenda in a little bit. I'll just, Mark, I'll get you involved here, and maybe you can talk a little bit about the growth story of Blackhawk, globally, and I guess particularly within Asia Pacific.
Yeah, most definitely. So back in 2001, Blackhawk was the first business to distribute gift cards into grocery stores across the US. And why this was unique was, whilst many other businesses distributed direct to their consumers through their bricks and mortar retail, this was the first time it was taken out of the direct relationship that customers had with their brands and went to an aggregated environment such as a grocery store. So this was a real breakthrough in what seems quite a simplistic business model. Fundamentally, Blackhawk at its core, it's our ability to transfer prepaid value from a brand to a customer, and that's across multiple platforms and at scale. The strength of our business is our relationships with our brands, and we know them in the industry as content partners, and to our customers and our clients, because that drives our success more so than anything else. For brand and content partners, it's a really good relationship that we have, and it's a really good value prop that we do offer, because gift cards can dramatically increase the distribution point. So instead of being purely in your physical retail or digital environment, you can go across multiple retailers now. So for instance, you can buy a Rebel Sports gift card now in Woolworths or Coles or Aldi. So Rebel Sport can expand their network and their audience that way. And for our distribution or merchant partners, it's really a strong proposition because it helps expand their basket size. So it works in both ways, and we are really there to facilitate that growth. So that's fantastic for both parties. But we really have two sides of our business. We have a commerce proposition, which is what most people commonly associate ourselves with. It's offering the gift cards at physical or digital points of sale. And we also have an incentive side of our business, which is a really strong and growing part of our business, which is where we work directly with businesses and providing them with gift cards that help drive desired consumer behaviours, or else could be through staff acquisition and retention programs as well. So it's really there to drive desired behaviours, and we incentivize that through just a humble gift card. It's quite simple, it's pretty basic, but at the end of the day, it works because people love it. From a global perspective, we've grown from 2001. A lot of the growth has been on the back of organic growth, as well as a strong acquiring process as well. We've acquired many businesses and associated organisations across the bandwidth and remit of wherever we can transplant prepaid value from one entity to another. Blackhawk launched in Australia in 2008 with a core focus on its retail distribution. So lifting and shifting the business model from the US around grocery stores, bricks and mortar retail, and lifting it into the Australian environment. From there, the business has grown significantly. We see gift cards in double-digit year-on-year growth across grocery and different retail distribution outlets, as well as digital as well, because it is that transfer of value. What we've also done in the last few years, we've incorporated a strong incentives business. So the Blackhawk Australia business acquired 2 organisations in Digital Glue and Edge Loyalty, and that's really given us a strong presence in the incentives market as well. So that really adds weight to our capabilities and market presence in this environment.
Okay, good. And I guess if you just reflect a little bit about some of the foundational pillars, for a fintech that first has to succeed locally and then expand globally. I guess looking back at the Blackhawk story, what do you think were some of the things that were done right before they started to move, more internationally?
Yeah, I think what the business did right was really just focus on its core proposition and get that and embed that as well. I think part of the strength of the business, and probably the core proponent of the business, is a relationship it's developed both with its merchant partners as well as its brand partners. And now the brand partners are trying to expand their presence globally. I think we've really developed strong global relationships with the likes of your Apples, your Amazons, your Google Plays, really desired content that consumers want. And we've really developed those long-term strong relationships across the globe. But there's been challenges along the way. We've had some really tough challenges with any acquisition of any organization. I think you find that it's always a challenge between you've got BAU and you've acquired this business and you don't want to disrupt BAU, yet you've acquired it for a reason because it needs to add value to your business, and you gain value through growing things at scale. So there's a challenge between not disrupting BAU, realizing you're a global business, so you want to implement your products and strategies. But at the end of the day, you only have finite resources to implement things. And when you're a smaller end market compared to a global end market, where do you sit in the prioritization rank? There's a lot of these challenges, as well as, and that's just internal. I think externally as well, I think what businesses have done really well over the last few years is really understand that not all customers are the same, and their needs and wants can differ significantly across different markets. We know, for instance, in the Australian market, gift cards are very much used for a gifting purpose, i.e. I'm buying my mum a birthday present. I don't know what to get her. I give her a $100 My gift card voucher because at least I know she shops at Myer. Whereas across Asia, a lot of the people are purchasing gift cards for self-use, and so it could be the gamer who wants to play World of Warcraft. I'm actually not very big on gamers, so I'm just making up the brands now, but they might be buying some content to get onto World of Warcraft, and they're purchasing this value, which they can actually use for a self-use purpose. So the customers differ, our merchant partners differ, and the brands differ in each end market. So we have to be flexible and adaptable to meet those needs.
Okay, thanks, Mark. We'll come back a little bit and talk about some of your partnerships in a little bit. I guess if Joel, just to get you involved here a little bit in terms of Spenda and FundSquare, both solve cash flow issues for business, in effect, helping other businesses grow. Can you tell me a little bit about the business model at FundSquare, and just talk a little bit about the types of clients that you're working with?
Yeah, sure. Thanks. So at FundSquare, we provide capital to innovative businesses from pre-seed stage right through to publicly listed businesses. So traditionally, these businesses have only really been able to get access to capital from selling equity. They don't get much love from the mainstream capital markets. So the product that we've been providing for the last 6 years is R&D finance. So the way that works is bringing forward the R&D credit up to 80%. What a lot of our clients do is bring that credit into the financial year so they have more resources to throw at R&D. So the benefit of that is that the business is compounding their R&D credit, sometimes by up to 35%, and increasing their speed to market as a result as well. More recently, we've launched a government grant option, so supporting businesses that are either already in a grant program or have identified a grant that they want to apply for. So the government has done an excellent job of providing support to industries in the form of grants, but the vast majority of these government grants are either 50% matched, meaning the business has to have access to enough capital to contribute 50% to the project, or they're milestone based, meaning the business has to complete certain activities to unlock the milestone payment from the government. So we can support by bringing forward the milestone payment from the grant up to 80%. So the business can use those funds on either meeting that milestone or moving on to another milestone if they're comfortable with the one that they're in. And how we can support even earlier than that is that showing that we will support the business with funding if the grant is approved. So that can be used as part of an application process as a grant. Grant bodies want to see businesses that are well capitalised and that have access to the resources to see projects through. And again, traditionally, businesses applying for grants have only been able to display that or show that to the grant bodies by showing that they've got investors behind them that are willing to back them through the project. So the success has been great today.
Yeah, no, I think it's obviously great because, not surprisingly, I work with a lot of fintechs, and access to cash is quite important. And not surprisingly, the R&D tax credit is something that sometimes people are really on top of, sometimes they're not. And I guess there's quite a bit of a delay in terms of the R&D tax credit and actually the cash coming in. So it sounds like a great business. We'll come back to talk now. Probably going to talk a little bit about partnering because it's obviously quite important, in terms of key theme that we're starting to see, continue to see within the fintech space. You see with the bigger banks, I don't know if they're partnering, they might be acquiring, but there's lines of sort of partnering with some of the bigger banks, for example, with the fintech space. And I talked, this obviously was a bit of a theme down at the Intersect conference, back in June down in Melbourne, sort of pre-COVID. And I guess I probably just want to talk a little bit about the three of you in terms of your partnership sort of approach. Joel, obviously you work in partnerships, and you've got an expansive community of partners, that offer a holistic sort of network and connections. Can you provide a little bit of, what you do kind of in that partnering space?
Yeah, sure. So as you said, we have a very expansive partnership network, and I don't think my founder will mind me saying that we wouldn't be where we are today if it wasn't for the great businesses that we partner with, like BDO. So partnerships is a huge part of what we do. We don't just want to be a transaction for the businesses that we work with and that we provide with access to capital, because we know that those businesses and founders and CFOs have a lot more headaches than just getting access to capital. That's just one problem that we solve. So we have built this partnership network so that we can help the businesses that are coming to us to solve that problem by solving other problems for them as well. To be honest with you, we actually see our clients as partners. We're a partner on their growth journey because we have clients that work with us year on year, and we get to see businesses going from that pre-seed stage all the way through to raising their Series A and raising their Series B and onwards. When COVID isn't around, we really try to foster that partnership ecosystem as well, by bringing together a lot of our partners and our clients into events and getting them into the same room and making sure that opportunities for collaboration are realised. Yeah.
Okay. And Mark, I guess coming to Blackhawk for a second, I guess you've got a proprietary scan to buy platform known as ScanIt, which leverages the QR code technology that allows people to buy tickets, passes to top retailers, including concerts, museums, zoos, and other attractions. I guess what's kind of the thought process that Blackhawk has in terms of adding and identifying new merchants to add?
Yeah, so just a bit of background on the scanner technology. It's, as you said, QR-based technology where it's the name gives it away. Consumers can scan a QR code in store, and then they can, or an online mall, and then they can take it and choose from a range of branded gift cards. So the beauty about ScanIt is you can pay in multiple ways. You can either choose to pay online with a card or through your digital wallet, or you can pay with cash at point of sale. And why this is a really strong proposition especially around the cash proposition, is we find that especially in a lot of end markets, that cash is still a predominant form of payment. So this allows people to pay with cash and get involved in the digital world. And that's great from a merchant standpoint, because it allows merchants to offer a digital solution outside of its physical retail environment. So we all know that retail space is quite limited. By creating this digital environment where people can still shop at, it allows that merchant to come on board and then increase its basket of goods that they can sell to its consumers, which is fantastic for them. In terms of bringing merchants on board, we really want to have a long-term partnerships with our merchants, because again, we see true value in the network effects it can bring. So if we have a good partnership with Woolworths, or we have a good partnership with Coles, or we have a good partnership with a small mom and pop store in India, this helps grow our network and our footprint, which means that we can take this value to our branded content providers and say, we've increased the distribution. Would you like to join us on this program? So it's very much a dual effect from both sides of our business and both partnerships we have to engage. There's a pressing point that we want to make sure our technology is sticky enough so people don't switch very easily, but also it's adaptable enough for implementation, so it's quick and easy and doesn't disrupt general business flow as much as possible for our merchants. So we're very particular in the merchants we want to select, because we want to have that long-term relationship with them, and they have to have that same mindset as ourselves. So that's a key part of it. We've got a strong kit of technology that we can implement into various businesses, because across the globe we've developed APIs and we've connected to various points of sale systems. And so we know what we can do, but we are ensuring that we have that long-term relationship, because again, all implementation projects can take a short period of time, or they can take a long period of time, but they are an impediment to doing business. So we want to make sure that relationship exists.
Okay, and I guess specifically there was, Disneyland. You have a new partnership with, a partnership with Disneyland, and I guess maybe if you can talk a little bit about how that started, and I guess are you looking to extend that, from a global perspective?
Yeah, and the Disneyland retail relationship is very much built on the Scan-It technology and the Scan-It platform, and so we've got a strong content relationship with the Disney business across the globe. And so this allowed us again to tap into that content passes into Disneyland. We know that through COVID and through the pandemic, there's been an acceleration of contactless payments and digital payments in every form of life. And so this has been a core component of what we're trying to do. We now have different retail locations and merchants such as your Kroger's, your Giant Eagles of the world, so big shopping centers that allow them now to sell a wider range of content, and that's beneficial for them. Again, it's beneficial for Disneyland because it expands their capabilities. It also taps into the consumer drivers around contactless payments. So there's a lot of win-wins across the globe, and this is a great case study for that. In terms of similar initiatives in the APAC, we're really looking to roll out this technology in India and Indonesia at this stage. So we're doing a lot of pilots in various cities. It's great working with big end markets with huge populations, because a pilot can be 4,000 retail outlets and it still is a small dot in the grander landscape. So we are expanding in India and Indonesia at the moment from a pilot standpoint, but really trying to understand that customer and the consumer behaviors and really trying to tap into that right content. We do find that now that people are increasingly shopping online, that cash to digital transformation is a real beneficial proposition for the end user. And so we're working with these retailers to help deliver that for them.
Okay, thanks. Adrian, I guess, seamless integration is a core driver for your business model. Spenda integrates with a number of systems, including small business accounting systems such as Xero, larger ERP solutions, and e-commerce platforms. What's it been like from your perspective getting these partnership working, and why is it important, and what tips would you give to other founders?
Well, as you said, integration's fundamental to our strategy and really delivering a solution to the customer. And I suppose what I'd say about partnering generally is when you first start out, you find you're going and you've got to kind of work in with a program, and the partner program of various vendors. It's never going to be perfect for what you want, but you got to kind of play the game. So it's a bit of a suck it up kind of vibe. and over a period of time, we're kind of at this point now where the sort of the tables have turned. So we're now focusing on allowing people to integrate with us, and part of that's actually a confidence thing. So you believe that people will want to integrate with you, and therefore you need to affect that program. And I suppose that's that sort of scaling big small kind of vibe. So I mean, partnering's essential, and program value really gets down to personal relationships. You need to be close to the key partner channels in the vendors that you want to work with. If you see opportunity to expose their customer networks, obviously they've spent millions or tens of millions of dollars on attracting those customers. So if you want to ride that wave or get in behind that comet, you're not going to get that just by being on their marketplace. It's human beings, want to work with other human beings, and partnering isn't about a logo in a marketplace. It's really about grassroots fundamentals. Hey, I heard this solution was great. I did this for one of my other clients. So understanding that is sort of transcending the technical partnering into more about how you go to market. But as you'd expect, like Microsoft pioneered that, and it's adapted over a long period of time, and you've got lots of really good global programs now. So my general view would be that partnering, exactly as Joel said, it's a critical part of rolling anything out. And as Mark said, we view our software is all about collaboration. So our customer, if you like, is the person that brings us our next customer. So we 100% take a partnering mindset to every relationship. It also means that you scale in a different way. So you've got relationships that are tight, and then relationships that are, almost like self-serve. I'm just going to use this thing, and that's cool too. So it's a really exciting landscape out there if you can unlock it and drink the Kool-Aid until the point in time when you don't have to anymore.
Yeah, well, I guess the three of you obviously are heavily involved in partnership arrangements, and I guess just a general question for any one of you. I guess how long would you say you can tell before a partnership's working? Obviously, there's a fair amount of work that goes into it before you start partnering with someone. But do you guys have like a rule of thumb to sort of say after 6 months, 3 months, a year, when's the appropriate time to kind of reflect whether or not that was a good partnership? Because we talked a little bit at Intersect. Obviously, there's bad partnerships, and making sure you don't go down that particular path, or how do you extricate yourself, quickly. Maybe Joel, I'll ask you because you're Mr. Partnerships. What's your general sense on that?
I guess it comes down to what you set out as what the objective of the partnership is at the beginning, and what you're trying to get out of the partnership. So from my perspective, and from FundSquire's perspective, if our clients can start getting from the partnership value from that partnership day one, then that's mission accomplished.
Okay. Adrian, Mark, I'm not sure if you have any thoughts on your sense of how long it takes to assess how that partnership's working.
Yeah, I mean, for me, I tend to think if you're going to go down the partner route, depending on the complexity, like if there's a lot of technical DD and that kind of stuff, that can really blow things out. But it gives you an opportunity to build relationships. But it also probably means that you've got a very direct plan for how to unpack value. So you almost hit the ground running. And perfect world, day one, you want to get things moving. But there's nothing like a partnership where you've got a mutual customer that's driving value. You can then see the yin and yang of the relationship, and we've got a couple of good partners recently where they're a big part of shaping where we're going as an organization, and they're almost like the strategic pillar that you fold into your business without actually having to pay for them.
Yeah, and from my perspective, I agree with what both Joel and Adrian have said. I think we look at things from probably 3 stages of the relationship. It's pre, during, and post, and that's probably from a purchase standpoint. But again, the post, hopefully it goes forever. But the pre, there's always red flags or green lights along the way. if there's an issue in the pre-purchase process, I think that's a red flag, and then you have to question the validity of the relationship. During the purchase process, if there's green lights, you can see some positivities. If you're doing a discovery of your mutual customers, well, and you have mutually aligned goals, I think that's critically important, and that really comes out both in the pre and purchase. I also think post is really important as well, because post implementation, you really have to make sure you have that ongoing relationship. So you can tell by the level of investment on both parties and how long they want this relationship to last for. And there's always signposts along the way. It's based on how often you catch up, how often you have conversations, what you're doing to grow each other's business. They're the keys to success. And if you're aligned with your partners, this can really create strong network effects as well, both across your partnership group and their partnership group, and you can expand across different market segments. No, a strong partnership is critical to our business, and we wouldn't be where we are without them.
Yeah, it's quite interesting, because it sounds like a little bit like an audit relationship. I can tell pretty quick after my first audit, is this going to be fun, or isn't it going to be fun? So it's probably, probably from an audit perspective, it just takes a while to sort of change tack, so you normally build momentum over that period of time. So why don't we switch a little bit to funding? Joel, obviously great news with FundSquare announcing $75 million sort of investment from Tassanara Capital last week. I guess maybe just talk a little bit about that, and what are sort of the plans now that you've had that injection of capital?
Yeah, sure. So we've been really fortunate to have had some really great support in the past from funding partners here in Australia, but bringing Tassanara in with the debt and equity transaction that's just completed means that we can really move into the next stage of growth for us. So we're going to be building out the team significantly across the globe. So the government grant product that I spoke about earlier is going to be officially launched in a couple of weeks. Prior to this, we've have been doing this product exclusively with our partnership network. So we have another product that we're offering exclusively in our partnership network right now, which is revenue-based financing as well. So in the coming months, that's going to be officially launched into the wider market as well. And there's going to be a lot more tech investment. So we've already have our own tech platform that our clients use for the application process and in an ongoing basis as well when they're working with us. So there's going to be a lot more investment into that to make sure that we maintain being the best in market for user experience as we continue to scale as well. So we've got a lot of things on the roadmap, including new products and new markets, but I guess watch this space.
Okay, sounds good. Very exciting. Adrian, you could probably be considered a veteran of raising capital. You mentioned before the webinar started, you're the only one on the call that has been involved in multiple earthquakes in Australia. So that sort of shows sort of that savvy you have in terms around the business world. But you're obviously a veteran. You're private equity, IPO, mergers, acquisitions. I guess, what advice would you give to fintechs for accessing capital sources, particularly when they first start out?
Well, one thing I would say is businesses like Joel's would have been magnificent if they existed 20 years ago, to be blunt, because it's a real challenge raising money. And I mean, the first time I raised money, I borrowed $2,000 off my dad, and he charged me interest, and I repaid it as a loan. But it got me started, and not everyone gets $2,000 from their old man, so I was reasonably happy to get that. I wish I'd been my sister's, because I'm sure he wouldn't have charged interest. But on a side note, I suppose the challenge when you're raising money is actually finding the investor that's the fit. So what I mean by that is you go through this experience, and it's sort of like Goldilocks. Oh, you haven't got enough customers. Oh, you haven't quite got enough revenue. Oh, blah, blah, blah. Something isn't quite right. There's always like what I'd call a pretty lame excuse. And that finding that sweet spot where you can connect with someone that actually backs your vision, that is the hardest thing. And then if you can leverage that up, I mean, I'm a massive advocate for greater investment in R&D, and I think the R&D government funding programs are excellent, and the utilization of them and that bring forward of revenue is clearly very helpful. Because as I said at the start, a lot of R&D gets funded and it almost gets misshapen because in Australia, you can't go in and say, hey, you know, my name's Adrian and I'm a $10 billion company and I'd like some equity. That just doesn't happen here. You walk in and guys with money, you know, they could be farming guys or mining guys or whatever. So the way in which they value things is almost the inverse of how you'd like it to be. So you go and find a customer, and that customer is, you know, maybe if you can get 80% alignment with where you want to be, you can take their cash, prove up your capability, and then use R&D funding to take the next leg. And, you know, businesses like Joel's allow you to, you know, as I say, 25 years ago, they've been really helpful because you could take that accelerated step faster and faster and faster. So, you know, it's really only been maybe since 2019, 2018, where we've been in a situation where you go, you know what? We're not going to worry about taking shortcuts. We're going to build a product that's designed to scale globally. And you can only do that when someone backs you in. And, you know, we've been really fortunate to get some alignment with I suppose both Canary Capital and Kai Capital were really material in going, you know what, we think what you guys are doing are great, and they supported us, and that's given us, you know, I've almost passed us the baton now, and it's like anything, when you de-risk yourself, the next layer of capital becomes easier and easier and easier. It's like dealing with a bank, you know. I'd like to lend you $1 million. I don't really need it. You know, it's that kind of mentality. So the hardest bit is the first capital, the seed, and the money that you can get from government assistance is, you know, enormously useful if you can use it properly.
Thanks. And Mark, you sort of alluded to some strategic acquisitions that Blackhawk has done. Is there any one or two that you want to sort of highlight specifically? And I guess what value has that brought to Blackhawk?
Yeah, definitely. I'll probably highlight the latest two that we've made in Australia. And that was at the back end of 2019. The business acquired both the Digital Glue and Edge businesses, which had really strong incentive-based propositions. The Blackhawk business in Australia was predominantly a retail-focused business up until that date. So it was end users working with your bricks and mortar retail outlets, your Coles, your Woolworths of the world, etc. But they really didn't have a strong presence in the incentives market. And if we go back to the core competence of what the business does, which is all around the transfer of, you know, prepaid value from one entity to another, they were really missing out on a huge part of the pie, which was this incentives-based business. And so with the acquisition of both Digital Glue and Edge, that's really increased our capability and competency in that market. It was very much a build versus bought mentality, and it was a lot easier to buy that capability with the resources that we did have at the time, just to grow our business and really penetrate that market. So that's really allowed us to scale in that incentive side of the business, which is you know, probably half the overall value of gift cards in Australia. It's, you know, a huge billion-dollar business there. And that part of the challenges is when you integrate three businesses into one over a pandemic, you know, you have those growing pains as you would in any other business, but also integrating technologies and platforms has been a bit of a slow burn. And again, being a global business where you sit in terms of the priority list, but it really has more so than anything else for our partners and our merchant brands, given them another route to market, another point of distribution, which has really helped expand those businesses.
Okay, thanks. We might just sort of pause there and take a look at a couple of slides that we put together that looks at sort of the broader equity landscape locally and globally for payments. And it's probably been the most successful fintech subsector as a result of the pandemic. And I think it tells an interesting story, just what we've seen in the last year or so. We will send around these slides when we send out after the webinar. There's 10,000 companies globally that make up the payment sector, and over 180 of those reside here in Australia. However, there are many subsectors you can see on the slide on the screen. We're starting to see a real focus on B2B payments, which is where Spenda and Blackhawk Network sort of plays. The next slide sort of talks about prior to the pandemic, the equity story highlighted how the payments landscape was becoming a bit saturated. In 2020, there was about a 14% funding slowdown from 2019, whereby the funding decreased for a second quarter in a row down to $21.33 billion. It was a 3-year low. The deal count also decreased in 2020, down 11% from 2019. However, last year we saw the rise, I guess, from fresh demand for payments, which was a record-breaking in terms of both deal size and deal value, which probably makes a lot of sense given what we just talked about in terms of the pandemic. In Australia, equity for funding payments has been witnessing an upward trend, reaching its peak number of deals and deal volume in 2021. It was a sharp increase in 2020, up 122% from 2019 here in Australia. In terms of deal share, we saw later stage deal share grow by 14% in 2020, and the seed share funding dropped by 52%. However, in 2021, we're seeing seed funding coming back to be about 42% of the deals, which sort of again indicates market demand is still there. If we break this down further to digital payments, we can see that after a previous decline in 2019, there was a 3% increase in financing in 2020, before witnessing a record-breaking year so far in 2021 in terms of deal and volume, with 59 deals and over 993 million of value raised. In Australia, digital payments also saw an increase in deal activity after falling in 2020. I guess for the three of you, what's your sense in terms of the rise and fall of funding, and specifically within the digital payment sector? Does any of those statistics, I guess, surprise you? Adrian, maybe I'll start with you.
No, not at all. I mean, it doesn't surprise me to see that it was really skinny on the ground for startups a couple of years ago. That makes perfect sense. In terms of the today landscape, we certainly have had experiences where we're being offered money we don't want. To me, capital is, it's all about timing and looking at things over, the course of activities. But sometimes if it's really well priced, you just want to take it because you just don't know where the market's going to go. So, we're pretty comfortable with, with our cash position. We're not sort of concerned, but we're actually now on the other side of it, looking at businesses who maybe have got some good IP or whatever, and we can buy them and then roll them into our sort of commercial framework and take them to market and de-risk their operations. So it's we sort of moved, and that doesn't mean that funding isn't a continuing need, because for us, we're kind of in that B2B payment space where we're blending supply chain software, payments, and finance. So for us, it's now more about banking, treasury, and sort of I kind of say internally, I don't care if you want to pay me now or pay me later, you're going to pay me. And that's really what our product is all about. So I think the numbers are bang on what we're seeing out there in the wider market. There is an appetite to reinvest, and it's pretty cash rich out there at the moment, and people have got an appetite to ride this wave and probably support digital payment transformation and general digitization. I think for the next few years, certainly.
Yeah, I think it's going to be interesting because I think the subsector we're talking about is definitely trending upwards. I think what's going to be interesting is if you look at the wider fintech ecosystem, will there be money to go around to continue to innovate across the wider ecosystem, particularly within this space? I think clearly the answer is yes, because you can just sort of see that the market in the world is heading that way. Maybe I'll move just a little bit to innovation. This is a question that came in for you, Adrian, specifically. COVID has caused a surge in contactless payments. Do you think new innovations or technologies will be the catalyst for a greater shift in payments? Could we be looking at a future without EFTPOS terminals?
I think undoubtedly. I think the terminal will die in different markets at different times, and I don't think anyone right now has got the guts to say, it's going to die in 5 years, or it's going to die in 10 years. I think the key thing is that it is going to die. I mean, I don't carry a wallet anymore. I probably haven't for 2 years. I find it weird when I'm asked to produce something and I'm going, I don't know, like my healthcare card or something, a Medicare card when I got my COVID jab. Can I give you a photo? Kind of eyeball, and I ended up getting my wife to text it to me because that's just the world we live in now. But I think you've got this reality as well that we still have some banking customers that operate passbooks. So there's a generation moving And I think also in terms of the developing world, going cash to, for argument's sake, prepaid or loyalty cards is a really good way to shift that psychology. So, I mean, we're certainly putting a lot of effort into what we would call shaping the B2C payment landscape. My personal view is that the business-to-business payments, generally speaking, have always been on terms. So I think there's more, I guess, acceptance of innovation around digital payment in the business landscape. But in consumer, you know, we've done queue busting many years ago, and now contactless queue busting, executing payments, mobile wallets, you know, all that. It's really more mobility, protecting the cardholder's data, really de-risking and almost stopping a fraud before it could happen. So yeah, 100% we see the terminal dying, and it's not a big focus for us to invest in, you know, terminal integrations and all that sort of stuff.
Okay. And one last sort of audience question that came through around, do you see open banking as a challenger or aider to the new payments platform?
It's probably a little bit of both, but I think it's probably an enabler overall. I think if you look at open banking from a global perspective and not an insular Australian perspective, it's a fairly essential rail to work with, and we certainly have made our investments there, as well as, you know, the certain capabilities that, say, a partner like MasterCard would have, where we see the ability to use those rails, and then open banking in the last mile to really transact very efficiently.
And I guess maybe we've been talking a little bit about Spenda, but maybe you can talk a little bit about some of the key products and services that you're sort of providing. You know, supply chain disruption has and continues to, you know, to affect all the supply chains, and you can start to see a few companies really trying to get into this space. Obviously, there was Greensill that was in the market, and I guess what are some of the core products that you're kind of offering in this supply chain space?
Yeah, look, so I suppose for us, I mean, yesterday's news, there was 4 stories about supply chain, and most of it was about, you know, little Jimmy won't get his bike this Christmas because there's just not enough ships. But you know, you're looking at if you take it objectively, a supply chain to a consumer is the retailer, and that retailer could be online, it could be bricks and mortar, it could be a composite of all the above. But when you go back and, you know, retailer to distributor, there's another supply chain, distributor to producer. And then if you're going primary production, then you got out to, you know, the farm inputs, so fertilizer, feed, all that kind of stuff. So our platform, I mean, the whole concept was to change the way people traded. You know, we've done EDI for 25 years, and usually EDI is about making the big buyer win, and the big buyer gets all this value. So what we've learned over the journey is, if you do the 9 things before there's a payment really well, the payment is a bit of a fait accompli. And it's blending and blurring the lines between supply chain software and what I'd call effective transaction formation. So a practical example, a practical solution, that we've obviously just bought this green shoots business. We think there's a massive wave of what we're going to call Gen 2 e-commerce coming. And you know, not necessarily subscribing to some of the analysts like McKinsey vibes, but if you look at it conceptually, the biggest problem with e-commerce is the rate at which we execute returns. So we're now at plus 40% in Australia, and the problem with that is that we take payment up front. So we believe, so we made some announcements around what we call workflow payments some time ago. We've been really trying to perfect that as a craft, so that when a transaction comes in, we sort of stand on the shoulders of the concepts that Uber laid down, where they said, hey, you know what, we're not going to charge you now, but we're going to use your card to give certainty to the driver that you're going to pay. And when you complete the ride, then we're going to take your money. We kind of approach that in e-commerce. So we don't want to take your money up front. We want to know you're good for it. But when we know what we can fulfill, then we're going to take your money. And the reason for that is, as I said, that stock availability. So when you look at the ability to fulfill, whether it's a direct brand fulfilling or a retail aggregator, the problem they've got is, if I buy 10 things off you and I've only got 7 available, do you A, want to cancel the order, do you B, just want to substitute for those other 3 items, or do I just remove them from the order altogether? And in all 3 of those scenarios, there's going to be a change in the amount of money that needs to move between the buyer and seller. So if you press pause, resolve the order flow, you're actually saving both ends of the play significant amounts of money. So back in the old days, we learned, real clear that if it cost me $1 to process an invoice, it cost me $7 to return it. And so when you've got 40% now going digital and you haven't got stock on hand certainty, we're really seeing that as a big problem. And what we would call demand aggregation back into the supply chain is where that plays to our platform strengths, and we're kind of bookending that with collaborative accounts receivable and accounts payable, and offering funding when it's needed. So we've got some exciting sort of stuff happening in what we would call flexibility in business buy now, pay later, where we're offering a payment rail, and that could be teaching the customer to value terms of trade. So for us, we think there's this big road smash between selling and finance. And really, because the conversation the sales guy has with, say, a retailer when they're ranging is, hey, mate, if you buy $1 million of stuff off me every month, I'll give you this cracking price. What they really should be saying is, hey, mate, if you buy $1 million of stuff off me at this cracking price and you pay me via this platform on time, then you'll get this wonderful discount. That lack of multi-dimension in the negotiation and the ability to administer it, they're the things which we think will really drive adoption and utilization, into the future.
Yeah, thanks, Adrian. Very interesting. Mark, maybe just shifting over to you, I guess, a little bit in terms of, Blackhawk innovates, making connections through convergence of existing technologies, such as you recently unlocked billions of trapped or unused gift cards. I probably have a few down in my car through QR codes. Can you explain this a little bit, just in terms of that thought process and in terms of how this works?
Yeah, so I think the insight behind this concept is that we aggregate value as a consumer in multiple ways, and one of the key ways is through loyalty programs or frequent flyer programs, and we aggregate points, and often both the loyalty program provider as well as yourself, there's this value which sits on either the ledger of the loyalty program, which they want to burn as quickly as possible, and we don't actually realize it as a consumer as well. And we think that there's a great way for facilitating the use of that value is through gift cards. And the reason why is gift cards are easily synonymous with cash fundamentally, and they can be easily transferred from one entity to another. So we think there's a real opportunity there to work with partners such as it could be your Amex reward points or your frequent flyer programs of the world, to say, hey, you have this value which is sitting on as a credit on your ledger. You want to get rid of it because you want to burn out those points as quickly as possible because you don't want to take that forward. We know consumers have it there, and realistically they're saving for a rainy day, but if they can bring forth that value now and realize it through the use of gift cards, wouldn't that be a win-win outcome for everyone? And so we're starting to push that technology and that thought process in the implementations of what we're trying to do. There's still some work behind it. We're not at a fully fledged go-to-market product stage right now, but yeah, we think the insight around that is just to really, unlock that value for both parties, and we think it can work.
Yeah, it'll work for me, I think. Joel, I guess, what are some of the innovations that you're seeing? Obviously, you work with a lot of different companies. Maybe highlight a couple innovations that you think are really going to be quite good once they hit the market.
Yeah, so we work with a really broad range of innovative businesses. So there's a lot happening in the renewable energy space at the moment, and that's getting a lot of really good support from the government as well. I guess more specifically to fintechs, we're seeing a lot of payment startups coming out, and a lot of infrastructure as well, and a lot of startups that are coming out that are developing new software for to support the new technology it's like the next generation of fintechs, right? They're coming out with software solutions that's going to support the new technology that's going to be eventually adopted by the bigger players in the space. But yeah, we work with everything from medtech to pharmaceutical businesses, renewable energy, a lot of different stuff.
Okay, thanks. We only have about 5 minutes left, so we'll just sort of move into sort of final questions and sort of comments from you guys. I guess, Joel, you're someone who's helped, high growth tech and fintech startups. What advice can you give these operating within the fintech ecosystem to support their growth? So if you, any words of advice there?
I might be a bit biased about being in a partnership role, but I think that I can't stress how important it is to make use of all the partnership avenues that are available to startups. Taking introductions and meeting people in the space will inevitably open doors and create opportunities for your business. So there's so many organisations out there that really want to support the ecosystem. So a great example of that is BDO, and you have your BDO for Startups program. I'm in a Slack group that Mark Orchard at BDO has done a really great job at bringing a lot of people together, and it's a really collaborative and environment in that. But yeah, making the most of introductions that people are providing to you and willing to help you, and that's a great start.
Okay, Adrian, I guess as a founder, what sort of advice would you give to those emerging founders that are out there listening?
Develop resilience really fast. Just remember in your head that failure is actually a function of quitting. And if you can do that, it's okay to come 17th today, as long as you know what winning looks like. If you don't have resilience, you're going to get eaten alive. And because you'll have so many experiences where people tell you, that won't work, this can't happen, yada, 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 yada. And you have to just back yourself in, you have to back your team and be capable of almost ignoring the white noise, which, we all have moments of self-doubt, but the faster you can squash them and keep moving forwards, the better.
Okay. And Mark, I guess what advice would you give for fintechs entering a global market for the first time?
Yeah, I think probably the key thing is that you need to realize that all customers and all people are different in different end markets, and you can't take a lift and shift approach because you'll just design yourself for failure that way. I think what's really important is to do your due diligence up front. This is a measure twice, cut once mentality. Understand your target audience, understand where your competitors are, really refine your value prop and your position against your competitive set. Also leverage partnerships, develop those relationships early on. And leverage any global partnerships where you can, and make sure you have enough runway where you can afford to be patient and not try to rush things, because you can easily get caught in the fact that you may not be getting the results up front. So you may try to turn the taps too quickly, and then you'll just build yourself up for failure. So it's about being patient, having the runway, being smart, and just being a bit lucky as well. I think that there's a confluence of all of those initiatives, and you should be fine. Yeah.
Sounds easy. So now that's great advice, you guys. And I think partly it's that resilience that you talked about, Adrian, but you kind of need that sounding board of people that you can actually trust as you go through the process. And so I guess that's partnerships, or it could be the key people that are kind of around you, because I work with a lot of fintechs, and some they just need a bit of direction. So you need to figure out who's going to be able to help you on that particular path. And it's not going to be everyone, because there is a lot of white noise and a lot of people saying no. So you got to figure out who that core group's going to be to help you get to the finish line. So that brings us to the end of the discussion. And thank you, Adrian, Mark, and Joel, for your valued insights. I think everyone would have found that this was a great session. You'll see on the screen now the next details of our next webinars. We have 2 more for the rest of this year. We have a great lineup of topics and speakers this year. Coming up, we're talking about artificial intelligence with Stuart Cobb, Global Head of Data Analytics and Industry Insights at Mindbridge, and Skolk Koch, Partner in Digital Advisory down here in Melbourne. And we finished the year talking about ASX listings with one of our corporate finance partners. So that's always a little bit of fun to close out the year. The details of this webinar will be shared with you following today's session. If you missed any of our previous webinars, my team will be putting up the links to catch up. And finally, before we close the session, if you can fill out a short survey so we can help to improve webinars on a go-forward basis. So thank you all for joining, and hope you can join us for the next webinar. Happy Friday. Thanks.
Just
Thanks, guys. Bye.